Welcome to the Phoenix Prosperity Podcast, where wealth meets legacy. Join your host, Tim Fergestad, as we explore the journeys of Phoenix's finest to success and beyond.
Hello, this is Tim Fergestad. Thank you for joining us. I'm very pleased to have Tiffany House with me here today. Tiffany is a tax, estate, and charitable strategist. I'm looking forward to hearing more about that and how that came about. Welcome to the show, Tiffany.
Thank you. It's a pleasure to be here, Tim.
Okay, so charitable strategist isn't something you hear very often, but I imagine it's intertwined very much so with taxes and estate planning.
Yes, definitely. Well, a lot of our best tax advantage tools out there are charitable because they've been in the tax code since 1969, and it makes good sense. There's a lot of other tools and strategies. I do work in those as well, too, that are not as well entrenched in the tax code, and they could have future ramifications if the IRS chooses to change their mind or something along those lines. So I love charitable tools, but there are other tools when you have a highly appreciated asset like a business, real estate, and really anything highly appreciated is one of the areas where I can really come in and help the most. I also help people who have estate tax issues. Income tax issues are kind of hard. There's some things that we can do, but if you're making a lot of money, you just kind of have to suffer and pay the taxes, I guess.
Some things, right? I mean, like alternative investments, like oil and gas, have losses that offset active income, which is nice.
Yep, exactly. Yeah. And so I call myself a recovering financial advisor. I was in practice with my father for 17 years, and we focused on ultra high net worth individuals across the country. That's where I learned my skill set, but I was horrible at trying to gain assets under management. I don't like selling. So eventually I decided I love charity. I'm very charitable myself. I have 10% of my estate going to charity. My husband and I do. And we also have a donor advised fund that our kids grant from twice a year. They're supposed to volunteer for the organizations, but that doesn't always happen.
Right. Okay, that's excellent. You've had a lot of designations. I think you said you gave up some of your licensing over the years, depending upon your focus and as it's shifted, but very, very, very educated and skilled. I think a chartered advisor in philanthropy was one, a CAP. Over your shoulder is the exit planning advisor as well.
Yep.
But advisor in philanthropy, that's again back to sort of the gift focus. Charitable strategist, is that what percentage of your clients or of your work do you use those sort of tools for, would you say?
Great question. I do have two businesses, one that works with nonprofits and their donors, so then I'm always using them. The other business works with those who have complex situations, usually of high net worth. And I will say that I have not had a client who didn't allocate something towards some charitable tool or technique. So it's not all of what I do, but I would say over 50%.
Okay, excellent. The more I've been able to, as I've grown, I've met all sorts of really successful people, and the majority of them do not. Yeah, the majority of them, I think that's safe to say, have some sort of estate plan, right, of enablement or empowerment, where they teach the inheritance is skill based. Right, knowledge base. It's not just a lump sum of money, because they know how toxic that can be.
Oh yes.
And so it's interesting to see how much they are. They set up funds. They have nonprofits that they want them to run, and they can help choose and run it and stuff. But yeah, it's meant for to help empower them to be more giving and to spread goodness. You have another
Yeah,
designation.
I call that values-based estate planning.
Okay.
And so I love getting involved with people and their whole families and help them to create and think about their family as not just a family, but more like a business. And how should things be run? And
Right.
taking some of that personal bias and things that can happen inside of there and create a structure so
Right.
that wealth can continue on for generations.
Right. That sounds like a family office in a sense. And you work like you kind of set that up or help people get into that space in between 20, 50 million when they go up or multifamily offices, or do you work with them or both probably?
Yeah, I do definitely. Not all of my clients are into that. I would say a lot of my clients don't like advisors. And so I'm come in a really unique space where I don't have any licensing. I don't sell any products. I only consult and give valuable advice.
Okay.
So then the client and I hopefully go to their attorney to actually draft anything that we might think needs to be drafted. But we'll check with the attorney first to make sure that it's in alignment. The financial advisor gets to manage the assets. I work great with financial advisors because a lot of their clients have their wealth held up in business interest or real
Hmm.
estate. So
Right.
that gives them a little bit more money to manage. So they love working with me. And the tax professional is the one who has to tell us what tax nut it is that we need to crack. So I get to
Okay.
work with the whole advisory team and really have that value add for the clients that I work with. And there's always something new. There's no playbook for this. There's a lot of opportunities out there of different things. So helping people find what tax advantage or asset protection strategy that they might want to do. We can find them the best strategy. Like a charitable remainder trust, you don't have to be charitable. As long as you lift a life expectancy, the amount of taxes you
Ah,
save is
okay.
going to have you come out and your family come out better in the end. So, but if that's the best strategy for a person that I meet with and they don't understand it, or if it doesn't fit inside their estate plan, it's
Right.
a horrible idea.
Right.
So, really making sure that the big picture perspective is looked at is where I come in. A lot of times I find that like attorneys are, they want to draft a document or they want to do the things that they know how to do.
Sure.
Where I advise on like oil and gas, I've got some clients who like the OBA bill, the One Big Beautiful Bill Act, but they're concerned about taxes going up. So, I'll help them find an oil and gas that they can put into a
Mm.
self-directed IRA, and then they can convert that to a Roth after the deduction. And now we
Right.
have some tax-free income coming in the future.
Right.
But I don't do any of the investments. I just help them find the right people and connect them.
Right. Right. I've done some of those conversions myself, and yeah, and find the oil and gas is a tricky one, right? Because
Mhm.
it's historically a funny industry. But yeah, once you find some good operators and have those relationships, those can be incredibly valuable. And often, right, kind of like real estate, I guess, like the short-term rentals, where you can get active losses in the first year, and then you can convert it into more of an LP role.
Mhm.
And as you say, you can mitigate those taxes in different ways as well later. Um, Another designation that I saw, which is kind of related, because I'm thinking about the business work that you do, is that you're talking about how a lot of people have a lot of their assets in businesses. The family continuity and exit planning
Mhm.
designation, which I think is really important and cool. But so maybe you can explain what that is to people first, and then I'll ask you about um, the logistics of it. So sorry, go ahead.
Yeah, no problem. It's actually a fellowship in charitable estate planning is
Okay.
my FCEP. So there are lots of designations out there. It's hard to keep them straight.
Yes, there are.
So yeah, so that is the designation. I am a fellowship in charitable estate planning. Helping people look at the big picture and create their legacy.
But in terms of businesses, right? So, um, a lot of greater wealth is created through businesses, and often they want to leave the business to the kids, but often that's a mistake. Right? And it's mom or dad's baby, so they want to keep it going, but they don't have the passion for it, or they don't, and so after a generation or two, things can really fall apart, and they I don't know. It's just so. Can you speak to those challenges, and how you parse that stuff out with the family? Because I imagine a lot of this is almost like being a therapist.
Yes, definitely. Family meetings can be a bit difficult, but it's really important for everybody to come to the table and bring their ideas and be forthcoming, because you don't know when things like that might happen. So being able to be flexible and seeing things from different people's perspective, and then being the person who can then share that with the others, so that in maybe a different way, so that they can see it newly, can definitely help. But when it comes to planning the exit strategy for a business owner, it's important to look at a few different options. Family is great, and that can work out really well. However, you might want to have that backup plan. And if you want to do a tax advantage for an outright sale, it takes a couple of years. I mean, we can do it much quicker than
Right.
that, but the best planning happens 2 to 5 years out. So it might be something about gifting the kids something else, using the high estate tax exemption and gifting through that.
Right.
So there's a lot of different options, but one thing that is interesting for a family who is confident in their children and they are ready to pass it on, there's something called a charitable stock bailout strategy, where the owners of the business, or the majority owner, the parents, can gift their shares to charity, and they can actually end up having the company buy back the shares from the charity. So they
Okay.
got a deduction for the full fair market value of those shares. The company
Right.
can buy those shares back, and they can go ahead and retire shares. So let's say you had an owner who was a 50% owner, and they had two children in the business at 25%. They were ready to retire. Now, they could transition their 50%, gift it to charity, and get that full fair market value deduction. Then the company has to have enough cash in it, to be able to buy those shares back from the charity. Then they can retire the shares, and now the two children's the amount that they get went up to 50%. Now they're 50-50 owners in the business.
Right.
It sounds too good to be true. The one big sticky rule here is there can be no written agreement with the charity that the company or anybody associated to it can purchase the stock back. The charity reserves the right to be able to sell it to anyone, but that can be a neat way to accomplish a family transfer if
Huh.
you are confident in your kids running the business, which isn't always the case.
Sure. Sure. Sometimes it's just the employees you want to keep on, right? And they're like your family, right? And there's
Mhm.
ESOPs or other options, right? Do you see
Yeah,
many of
ESOPs
those?
are yeah, they're wonderful tools. So where I come in is I help and advise. I was referred to a couple by a business broker, actually, who wanted to do an outright sale for this business that they had. It was a great business. I spent 3 hours with those two going through everything and the pros and the cons. And
Mhm.
at the end, we said, you know what, an ESOP, you're ideal for an ESOP. I think this is a great path for you to go down. And then made the introductions. They were actually already talking to people who would help them with the ESOP. They were
Okay.
trying to determine between the two strategies.
Mhm.
Back when I was a financial advisor, I did two of them. But a lot of times when it comes to ESOPs, I take a look and say, you know what, I think you're a really good candidate. Let's bring in the experts.
Right.
The problem with the
Okay.
ESOP, you can be a tax exempt entity and do some amazing things, and you can create millionaires for all of your employees can be millionaires really quickly down the road. I've seen awesome outcomes, but you have to plan on at least a year of planning. I used to say $100,000, but I hear now it's more like $300,000 of due diligence, lots of attorneys. You need a team of
To
like
set up.
10 people to help you get over the finish line. And then you have to keep it up every year with doing valuations and education for your employees. But if you have great employees, it makes wonderful
Right.
golden handcuffs because they're not going to
Right.
leave when they get that great retirement plan.
Right. Right. Similarly, imagine not delayed or deferred sales trusts, right? Just you can for tax purposes, you can drag it out over a little period.
So deferred sales trusts are not one of my favorites because there is no IRS ruling on the deferred sales trust.
Oh,
So in my opinion, if something were to happen with a deferred sales trust, because I've been through my father, I say likes complexity in the tax code. So we played around with a lot of complex strategies that what were dissolved. And I think if a deferred sales trust is dissolved by the IRS or no longer available, then I think that people would just have to divest and pay the taxes at that time. I don't think there'd be any penalties.
right.
But when I look at it, if you're looking at selling like a $10 million business
Mhm.
and you're going to use a deferred sales trust, you're still going to be in, if it's a 10-year trust or something along those lines. I mean, you could extend it out further, but you're still going to be in high tax brackets each time you get a distribution. So I could
Right.
see it for like a business or real estate that was going to be sold for about like $1 million. And then you take that and say, okay, let's take $100,000 out each year for the next 10 years versus a million coming out, because that could help you with tax bracket planning. So that's kind of where I look
Okay.
for deferred sales trust. I have not seen it work really successfully anywhere else yet, but that doesn't mean I'm not open to it.
Okay. 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 Thank you for that. So, Tiffany, what are some of the common misconceptions about like charitable strategies?
I think that the biggest one is that if somebody wanted to make a charitable contribution with business interest or real estate or some other large asset, that they have
Mhm.
to give it all. And you don't. You can get
Hmm.
5%, 10%, 50%. I've done over 40 charitable remainder trusts. And
Okay.
whenever I set those up, we go to the accountant first and figure out, okay, how much taxes are going to be owed. And then we only sell as much inside the charitable remainder trust, which gives them lifetime income. And the asset gets sold tax free, so it saves taxes, gives you an income tax deduction too. We only want to put as much in there as we're going to be able to use the deduction the first year. You get up to 6 years to use the deduction, but we want to make sure that we're not, so it's always part of an asset. I very rarely, except for a few unique situations, put a whole asset inside of a charitable tool because we only want to solve for the tax problem we have.
Huh. Okay. Um, so I know for some, I've heard of people putting, let's say they have a $5 million apartment complex, and they would set up they'd make it. There's different ways of doing it, affordable housing based or something.
Mhm.
There's different ways of doing this too. So maybe you can shed some light on that. But for the most part, it has to be a particular type of organization or class that you're donating it to.
Well, the nice thing is you can have a lot of control over this. There's something called a donor advised fund that if
Okay.
we have any sort of more complex asset that we want to gift to charity, we're going to use a donor advised fund. I've called it before the poor man's private foundation. But the donor advised fund allows you to just have one charity, and then you can it is a 501(c)(3), but now you can
Okay.
grant over time however you want to any other 501(c)(3) nonprofit organization. So I like to use donor advised funds in situations like that. There's
Okay.
also something called a supporting organization that I'll make look like a private foundation. I'm not into private foundations at all because, or maybe not at all, but private foundations have a lot of rules, regulations, a lot of compliance. There was a lot of self-dealing in private foundations. So now if you were to gift an asset to a private foundation, you can only deduct the basis of the asset.
Huh.
It's 30% if it's an adjusted, or I'm 30% of adjusted gross income if it's stock. I'm sorry, no, 20% and 30% for cash. 50% for cash. So there's limitations within the private foundation. If you're going to gift cash, private foundations are fine, but I say cash is for amateurs. Because if you can gift an asset that's highly appreciated, you're going to save all those appreciation taxes. All those capital gains taxes are now saved, and you get to keep that working for you. In a donor advised fund, you're keeping it working for you in your own charitable savings and investment account. So you can grow those funds, tax-free compounding, but you get the deduction the year you make the gift. So you can utilize the donor advised fund the year you need it the most, like when you've sold, when you're selling a major asset.
Right. So when you say you might put only part of an asset into the charitable trust or whatever vehicle, let's say it is like that $5 million apartment community, you could put $2 million into it, and then what happens to the remaining ownership? You would
keep it outside. Now, it does depend on how it's structured. So if it's an S corporation, you can't use a charitable remainder trust, but you could still use a donor advised fund. So there's some limitations on how it's actually structured. But with an LLC, all you do is say, hey, let's go ahead and give a percentage to a charitable tool and keep the other interest and just sell it outright. And when you use a charitable trust, the donor can be the trustee. So you still have control. You're not losing control. You can choose when to sell the asset and all of that inside of the trust. So that makes it really nice, because I find that business owners and real estate professionals go hand in hand in that they like to have control over their assets.
Sure, for sure. But if part of it is already been donated away, how much control do you have?
As long as you have majority, as long as you have 51%,
okay.
you still have full control. And so you get to decide when it gets sold. So you get to keep that control.
Okay. And if you put the whole property into that, you can run it and so forth up until a certain point, but it's ultimately, you get the tax advantages and all that stuff for donating it, but that now belongs to the 501c3, and that's basically committed forever, right?
So with a charitable remainder trust, you get to get income from it for life, plus the tax deduction. You get to sell it tax-free inside, so keeping more of it for you. And if you have estate tax issues, it's outside of your estate for estate tax purposes. But for like a donor advised fund or supporting organization, that's what I like to use instead of a private foundation.
Okay.
Those funds are always they have to now go to charity. So where it works out well is for somebody who is charitable, that they can pre-fund their philanthropy. So you say, hey, some people tithe or give 10%. I have one gentleman I helped who sold his insurance business, and he gave 10%, not because he was religious, but because he was a bit of a bad boy and struggled with drugs and alcohol when he was younger. And so he was just super grateful to be here. So he gave 10%, and we were able to, the year of the sale of his business, we were able to create the donor advised fund, fund it, and pre-fund his philanthropy. He chose to do it for 5 years, but now we get to invest those funds inside of the donor advised fund, so that can even grow more. But you could pre-fund philanthropy for 5, 10, lifetime, whatever type of deduction it is that you're looking for to help offset the portion of the asset you sold outside of the charitable tool.
Okay. I could go into the weeds some more on this, but I think I'll spare people. Okay, so you have tools available that you that helps you walk through different scenarios and different classes with people. Can you share a little bit about that, please?
Yeah, so I am known for my tools matrix. I am a nationally recognized speaker. I do a lot of education for professional advisors at bar associations, estate planning councils, the National FPA conference. So I create a matrix of, okay, what type of business is it? Is it an S Corp, C Corp, LLC, or an asset? Which tools, charitable and not, are options that can be utilized? And I do have that as a download off on my website as well, too.
Okay, okay.
But I have other ones that compare a donor advised fund to a supporting organization and a private foundation. I've got one that just talks about all the different charitable trusts that are out there and when and how you would use them and how they work. And also for planned giving for those that want to make gifts of assets or legacy gifts to charity. So yeah, I get known for that, and I love flowcharts. So I'm not somebody when I present where I have slides with lots of words, but we never cover them. They're for people's own and reading enjoyment for if they want to get to know the tool more. I love flowcharts. That's how my mind works.
Okay. Very cool. Very cool. So yeah, I'm sure that can be a great resource for people. And it's just most of those or all of them are on your website?
The business sales and the charitable trusts are on my website.
Okay. Excellent.
But I'm happy to share the other ones as well too.
Okay. Do you mind sharing a little bit about maybe your legacy plans?
Yeah, so my husband and I, when we got married 7 years ago, and when we met with our attorney, we let him know that we wanted to leave 10% to charity out of our estate plan. And what was neat was when we came home and told our daughters, hey girls, instead of 33 and a third percent, you're each getting 30. They said, oh yeah, of course, we know how charitable you are. That's wonderful. And so we get to actually share our charitable legacy with our kids while we're alive. But one unique thing we did, and we had our attorney do in our estate plan, is to list all the charities out in a separate schedule. So that way, if we want to change our mind, we can in the future, so that it's not set in stone. And every time we change our charitable intent, that we need to go in and change the whole document. So that happened one where a friend of mine founded a charity. And they used to be involved in the Arizona Charitable Gift Planners, which I used to be president of. My father was president of, and now my husband's president of. And they weren't coming anymore. I'm like, why don't you guys come? And they're like, we're going to solve this issue in the next 20 years. And I'm like, okay, well, then I guess you don't need my estate plan because I'm hoping to not die within the next 20 years. So then I was able to allocate that percentage that I was giving to them to another organization I was on the board of.
Okay. Interesting. So I imagine our listeners aren't maybe familiar with the Rockefellers, for example. They're kind of like the poster family for generational wealth and legacy, and part of that is through their family constitution.
Yes.
Right, just setting forth some rules about how to keep things successful for generations. I like to draw a parallel between the Vanderbilts and the Rockefellers from both about 100 years ago, and how they're both the wealthiest families at the time, and one of them grew their wealth, and the other one lost basically all of it. So, can you talk a little bit about those sorts of planning tools? Do you implement things like that?
Yeah, definitely. Well, first of all, it kind of goes back to our previous conversation about educating the family and figuring it out kind of like a business. And one of the key factors in that is human capital. So I forget if it was the Rockefellers or if it was another very successful family, but the son didn't want to come in and run the kind of the family office. He was very charitable, and he wanted to handle all of the charitable work. And when the family could recognize that and know that each person in the family has a different skill set, different morals and values, and different objectives that they want to accomplish. And when you can put that in together and really help that family understand what it is that they're best at, then they can work together that much
Right.
better. So it's really important to really look at the human capital piece of it.
To build in that
And
flexibility to be able to adjust and pivot for all the different variables that will come up, but still have some guardrails on to make sure things don't
yeah, and so,
fall
making
off.
like parameters like, okay, who gets to make a decision? How many people need to be on board with that? The patriarch and the matriarch usually, want to have full control, but it really helps best when they say, okay, let's make a process out of this. Let's have due diligence that needs to happen. So it's not just us saying yes or no, and then we die, and then we've got the kids fighting and what have you, but to actually teach that business acumen and the family and different like business dynamics to help the family out can be really empowering. But also how you transition that wealth to the next generation. I love putting handcuffs on things, put some little guardrails up. So there's different ways to do that through trusts, and there's a lot of different types of trusts out there. And the trust can also help you avoid estate taxes and other things on some of those assets. So I'll help families give a very highly appreciating asset to the next generation in life and allow that to grow outside of the estate for estate tax purposes, but still keep guardrails on it so that the kids can't come in and mess up with it too much. So
Right.
I love doing those types of wealth transfer that's really going to empower the next generation.
Okay. Excellent. Very cool. Um, as I have one who's just flown the nest, and I'm at that stage of trying to plan differently, and I'm actually writing a series right now, a legacy series on about how it's not just financial, right? It's your heritage and knowledge is the large. What's that Sanskrit proverb? Um, uh, it, if you have a smart son, you don't have to worry about giving him a big inheritance. And if you have a dumb son, you don't have to worry about giving him an inheritance anyway. So either way, you really don't have to worry about leaving them anything. It's more about what you leave in them.
Yeah, it's more about what you leave in them. I like that. I hadn't heard that one. It's what you leave in them. I'm going to use that one. But one question I always like to ask people who have wealth and want to transition it down to the next generation is how much is too much?
Right.
I I have seen people give in life and have their children just quit working and waddle it all away. Five
Right.
years later,
They lose their purpose.
yeah, they lose their purpose. They have no job. They have no skill set now because they've been out of the workforce for 5 years. They can't get employed. But I do like the putting the training wheels and the guardrails on it. So I do like giving in life, but only giving at, small increments. And right
Right.
now, the estate tax, or I'm sorry, the gift tax exclusion for each year is $19,000 per person to per person. So meaning that I could give $19,000 to each of my three daughters, and my husband could give $19,000 to each of our three daughters. So, it ends up making it so you can give 38,000 a year to children, but also help them. One thing my husband and I did last year, and I think we'll do it again this year, is we funded Roth IRAs for our
Mhm.
daughters. So we put the money in there for them. One of them we were able to max out. The other is 17, and so she only made like 5,500 last year. But putting that money in there, and the stock market's done great. I think her Roth has grown by 14%. So it's a way to be able to
Right.
help them in the future and teach them what's important.
Right. Right. That's a good one. I've done that with my kids as well. They've been able to max out their Roths for years, which is nice. Um,
Yeah.
although my son's off the payroll now and gone because he can't come and work on stuff. that's another story. Anyway,
You definitely like I have my daughter, one of my daughters doing all my social media, and my other
mhm,
daughter helps me with I do have a business that helps nonprofits fundraise and
okay,
ask donors for complex asset gifts too.
okay,
So she can, I put together so many materials. She helps me in that
nice,
business. And yeah, I'm hoping one day that the two of them will want to take that business and run with it. But my tax and estate strategy, which we were talking about today, that takes my mind and my experience and expertise because there's no playbook on how to put together complex master game plans. It really it has to incorporate the morals and values of not just the matriarch and patriarch, but of the entire family. And think about, is there a kid who has drug or alcohol propensity or abuse? All those different factors. So I like to get
right,
to know my clients very well, and I always ask them, how are your kids? Are
right.
they good kids? And how much is too much to leave to them?
Right, right. That's one of the things I mentioned the legacy plan series that I've been working on is the different inheritance models I've seen. I've seen some interesting ones. Um, for example, one is a match program. So whatever they make, the trust will match, which I think is kind of a good incentive based one. Um, One was like a Brewster's Millions scenario, which I thought was interesting. If you're familiar, it was like if you could get your hands on like 2 million, then you could have 5 million of your and then and then there was another tier and stuff, which I thought was kind of interesting. Or there's the knowledge based one. Like I got to meet Shaquille O'Neal a couple of years ago, and his was 2 degrees to touch daddy's cheese, which I thought was good. Uh,
I
yeah,
love it. 2 degrees to
yeah.
touch it. That is awesome.
And he had a
I did
signing
not know
bonus
that.
too, kind of thing. I think he wanted a doctor and an attorney in the family. So I think it was like $1 million bonus if you went to law school and $1 million if you finished or something like that.
That's
Anyway.
awesome. I'm writing that one down. Well, one that I have done before is having a trust, and in the trust, letting it be said if they wanted to start a business or put a
Mhm.
down payment on a house, that they
House, right?
have to
Or
come
yeah.
up with half of it.
Mhm.
And then also, too, you can set the trust up to lend out assets at you have to use like the AFR rate, but you can lend assets out as needed to help the entrepreneurial spirit of some of those kids, but they definitely have to have some proof in the pudding. So I do like the
Right.
match there as well of,
Yeah, right?
what, if you save $50,000 and you need 100, well, then, first save the 50 and then the trust can give you that other 50.
Right. Right. And which is, I mean, the traditional one, well, I guess the default one is we're gone, we died, here's all your stuff, right? And the average inheritance age is what is it? It's around 60 or something in the US, I think.
Okay.
which
I'm not
which is
sure.
kind of a little late for being useful for most people, right? And so what a lot of trusts do, a second to that, is a staggered scenario, right? They get some at 20, some at 30, some at 40 or something like that, which is maybe all right, but it's not really. That's kind of the trust fund kid scenario, which is I'm just going to wait it out and wait until the next check comes, and that's not helping them live their best life and find their own life of meaning, I guess.
Yeah, but at least they can't go blow it. So that's what my trust looks like is
Yeah.
everything. I only have one minor left. So everything is covered until for college and all of that until they're out of the house, as many
Mhm.
degrees as they want. But then they get one cut at age 25, 35,
Right.
45, and 55. But as we age and our children get older, I do highly recommend that everybody revisits their estate
Sure.
plan every two to
Sure.
5 years. You don't
Yeah.
even know how many things have changed.
Right.
I had, after I got divorced, I created my own estate plan in 2012 or 13. And when I 7 years ago, it was amazing. I'm like, oh my gosh, I wrote this in there. Or this was my guardian of choice, or what have you.
Right.
You don't realize how much
Yeah.
changes.
Oh, for sure. For sure.
Because it's kind of,
Um,
my daughter asked me, we just got a new kitten, and she was saying, she goes someplace for a couple of days and she comes back and she's like, I can't believe how much she's grown. But it's like our lives that we don't realize how many changes are happening in our lives, or how many new assets, or do we have them titled in the trust properly, and all of those types of things that are really, really important in estate planning. That those all need to be considered and step back and looked at.
Right. Yes. Periodically revisited for sure. For sure.
Yes.
All right, Tiffany. If people would like to connect with you and learn more, where can they go? What can they do?
Yeah, the best place to get me is off of my website. It is www.tax, T-A-X, and then a dash, and then estate, estate.com. They can also email me at tiffany@tax-estate.com, or my phone number is 480-242-9956.
All right. Excellent. Please, reach out and get your affairs in order.
Yeah. Well, and it's the one thing that I always think of why nonprofits aren't very good at gift planning is they don't like to talk about death and taxes. And I get lit up by death and taxes. So I'm the weird one.
The macabre of your industry. Okay. That's funny.
Yeah. All right. Well, wonderful. Thank you so much, Tim, for having me on today. I really appreciate it.
Yes. Thank you, Tiffany. And thank you, everybody, for listening and watching. And I hope you appreciated these insights into estate and tax and charitable giving and death and taxes. All right. Thank you very much.
Inspired by our guests? Visit phoenixprosperitypodcast.com/guest and join us on the show and share your success story with Tim. The spotlight awaits.